Once unthinkable bond yields, now the new normal for market. It was a week that bond market finally seemed to grasp what central bankers have been warning all year: higher interest rates are here to stay. From the US to Germany to Japan, yields that were almost unthinkable at the start of 2023 are now within reach. Now the sell-off has been so extreme it forced bullish investors to capitulate and Wall Street banks to tear up their forecasts. Yields on 10-year German debt are close to 3%, a level not reached since 2011. The US equivalent are back in line with the average from before the global financial crisis and within striking distance of 5%. The question now is how much higher they can go with no real top in sight after key levels were broken. Now, while some argue the moves have already gone too far, others are calling it the new normal, a return to the world that prevailed before the era of central bank easy money distorted market with trillions of dollars of bonds buying. The implications stretch far beyond markets to the rates paid on mortgages, student loans, and credit cards, and to the growth of the global economy itself. At the heart of the sell-off were the world's longest-dated government securities, those most exposed to the ever-growing list of headwinds. Oil prices are rising, the U.S. government is piling on more debt, and flooded with the shutdown and tension with China are on the rise also. For anyone who doubted the tough inflation-fighting talk of Jerome Powell and Christine Lagarde, against this backdrop, the read across is not pretty. What happened over the last few months was basically markets were wrong because they thought inflation would come down quickly and central banks would be very dovish, said Frederick Dodard, head of asset allocation at State Street Global Advisors. Everything will depend on how inflation lands over the medium to long run, but it's fair to say that we have changed from the ultra-low yield regime. Some of the world's most prominent investors, including BlackRock's Incorporated Larry Fink and Pershing Square Capital's Bill Ackman, are among those saying the current trend may not be done. Already the milestones have been coming thick and fast. Germany's 10-year yield just had its biggest monthly jump this year. Japan's government bonds saw their worst quarterly sell-off in a quarter century, and the US 30-year yield posted its largest quarterly jump since 2009. Even the risk of a U.S. government shutdown didn't spur a sustained bid for treasuries, the world's de facto haven asset. Over the weekend, Congress passed compromise legislation to keep the government running until November 17. Amid the rout, few corners of the market escaped damage. Austria's Century bond, a poster child for long-dated debt, issued during the low-rate era, took a fresh drubbing, falling to 35 cents on the euro. Meanwhile, central bankers continue to try to give the market a clear message. Federal Reserve officials led by Powell mainly stuck to their mantra of higher for longer rates. In Europe, European Central Bank President Lagarde is pushing back strongly against the idea of imminent relief. She told the European Parliament at the start of the week that the ECB would keep rates at sufficiently restrictive level for as long as necessary to cool inflation. Some chasing bond bulls such as T. Rowe Price got ahead of September's rout, flipping long bets on treasuries to shorts. Big blocks trades this week in Treasury futures targeted a steeper curve and higher long-dated yields. Until now, the aggressive rate hikes unleashed by central banks had taken the greatest toll on shorter maturities, driving yields up and resulting in deeply inverted curves. Expectations of recession, along with rate cuts in response, had kept longer-end yields pinned down. But in the US at least, that recession never showed up, forcing investors to price out monetary loosening. European economies have proved less resilient, but the ECB, which has a single mandate of price stability, has reiterated again that it's too soon to talk about easing with inflation still well above its 2% target. Exacerbating the bond move is a rise in the compensation investors' demand for holding longer-dated debt. In Europe, that so-called term premium could add 50 basis points to 10-year rate, according to Societe Generale. Rebuilding term premium can only feed long and steepening forces, said Adam Corpil, a rate strategist at the French bank. It looks like the pain trade of even higher yields could continue until something breaks. To be sure, there's a view from some that the sell-off has already gone too far. Take Jack McIntyre, a portfolio manager at Brandywine Global Investment Management, who has been overweight treasuries for much of the year and now senses a long-looked-for turning point. I think we're in the fear stage for treasuries, and that won't last, he said. In our mind, inflation is settling and growth will slow. We will get there in 6 months. Notable too was a revised forecast from Goldman Sachs Group Incorporated strategists, who now see 10-year treasuries ending the year at 4.30%. While that's some 40 basis points higher than their previous target, it's below current levels. At Candrum, global head of multi-asset, the force says The current market trend may not have much more to run, and she is considering gradually shifting into longer maturities. We believe we are at the end of the movement with signs of decelerating inflation and economies weakening in Europe, she said. We need to endure this overshoot phase in longer rates and take advantage of it. Even if the pressure on the long end starts to ease, another major test lies ahead of the Bank of Japan. The laggard among central banks globally edges towards normalizing policy. Yields have already crept to multi-year highs, ongoing despite effort by policymakers to stymie the moves. Japan would think is a live issue, and there's a debate to be had about what impact that should have on the global market, said Martin Harvey, portfolio manager at the Hartford World Bond Fund. It's a potential catalyst for further steepening and one that we need to monitor. As this week drew to a close, one piece of data offered the Fed some hope that it's getting on top of the inflation battle. Its preferred measure of underlying price growth rose at the slowest monthly pace since late 2020. But even if the inflation picture continues to soften in the US and elsewhere, it's clear markets are in a new world. We're just maybe reverting back to what the world looked like before 2008, said Rob Robbins, Chief Global Fixed Income Strategist at BCA Research. That period post-Lehman pre-COVID was one of inflation struggling to stay at 2% growth, being kind of choppy, and central bank having to keep rates very low for longer.